All right, I am now recording and we are live. Obviously, my name is Yusufa. You may see that written at the bottom of the screen, Yusufa C. I'm a Gambian living in Copenhagen, Denmark. I'm joined today with Ndonga, my good friend and you can say business partner. We can talk a bit more about that in a second. And we will soon be joined by our superhost, Modu. But in the interim, we can maybe just start having a natural chat, a light chat. Thank you all for joining. I can see we have some live guests here. We have Mr. J. Cole, Madam M. Danso, we have Moro, Sagnia, and Mr. Turulai Toki. So thank you. I'm sure others will join, and I'm sure Modu will come back. So guys, today the subject matter is investments, particularly raising capital in a Gambian context. Obviously, we're all Gambians, or at least I presume, those of you watching are Gambian, but I'm Gambian and Ndonga is Gambian. So this is a subject that's close to our hearts. Just a very, very brief introduction without going too long into it. I'm based in Copenhagen, Denmark, and I run a small investment company called IPO Capital. And basically what we do is we behave like private equity. So we're a business that buys businesses. We also make sort of venture capital style investments in different businesses in Europe. So far, we have acquired 3 companies in the United Kingdom. They're in a very boring sector, but I love it. They're in steel manufacturing. And those 3 companies combined do about $20 million in revenue and have about 200 full-time employees. And I'm currently running that group as the CEO. But really, we have very good operators that actually operate the business. So I'm sort of the M&A guy, the deal guy. And I also spend a lot of my time, just looking at businesses either to invest in or to acquire. So I don't want to give the wrong message. I'm not Jeff Bezos or anything. I work with partners, so I deploy partners' capital. So I'm not Yusufa Bezos, but that's basically how private equity works. Frankly, that's how investing venture capital works as well. What happens is people raise money, typically into an investment fund. It's other people's capital, and that's what they use to back entrepreneurs. So that's a very long-winded introduction. Maybe Ndonga can give a quick intro, and then we can just start a chat whilst we wait for Modu to join us.
All right, so thank you. So I'm a little bit newer to the VC and startup space than Yusufa and Modu. I grew up all over Africa. I am a Gambian though, and went to the United States for college and then worked in federal corporate tax accounting for a Big 4 company for 7 years until last month. So I've been there. I was with them for 7 years. I was a manager, and I actually started working with Yusufa and Modu a few months ago because of my interest in pivoting into the startup venture capital space. And as a Gambian, I've seen so many countries in Africa that are a little bit more developed than us, and I've seen how investment in the private sector and growth in the private sector can really lead to development for a country. And that kind of is what motivates me into really seeing what we can do from a Gambian aspect.
Absolutely. And, as Ndonga mentioned, January 2021, this year, the 3 of us got together, myself, Modu, who's unfortunately not yet here, but Modu runs startup brand Banjul. And my understanding of what they do there, obviously I'm aware, but it's hard to pitch for someone else. They help empower Gambian entrepreneurs. So they run they host a lot of events, conferences, things like this, where they really try and bridge the gap between Gambian entrepreneurs and whatever resources they need, whether that's investment, advice, or whatever that is. So we came together and we said, advising entrepreneurs is one thing, but quite often what founders need is capital. So we set about this journey together, putting something that we are calling the Safari Funds. Our big boss is here. Yes, one.
Sorry, I was just set up my internet. Glad to.
We've introduced ourselves. We're talking about the subject matter. We're going and we're recording. So no problem, boss. Thank you. No problem.
Thank you so much for taking up that. So I'll just let you go on, and then I'll just take it up from you.
No problem. No problem. Yes. So just briefly to wrap that up, Modu really had the zeitgeist of an idea that we've now come together and said, let's put together, one of Gambia's first investment funds. We're not yet there. We're just starting out. And what we mean by that is a professionally managed investment fund whereby we raise dedicated capital, and some material amount of capital. So, $7-figure US dollars eventually, to then go and back Gambian entrepreneurs. But, even investment companies are also startups. It sounds a bit like an oxymoron, huh? But, even a $1 billion investment fund is a startup on day one. And so in a way, this is a startup. And so what the phase we are now is we're in the proof of concept phase. Before we could go to investors and say, inject $500,000, $1 million, $2 million, we need to show them that there's opportunity. We need to show them that they are talented entrepreneurs building, good, compelling businesses in Gambia. And really the way to show or rather the way to tell is to show. So what we're trying to do is to put, a little bit of our own money, not a lot, but just back some founders at this early stage, either through micro grants, so anything from, let's say, $10,000 to $100,000, so micro grants, or some micro investments, anything from $100,000 to say $1 million. So, as I mentioned earlier, Moro, I told him that we're not Jeff Bezos. We're just young Gambians trying to do our part. But hopefully, if we can get some traction, then the idea is at some point we can welcome investors and set up this professional fund. So, boss Moro, I'll hand it back to you, sir. And we've introduced ourselves and we've already started. So please take it.
Thank you so much. The rest of actually, it has been an amazing, time spent working with all of you on the pilot project Safari Funds, as you have indicated. I think one thing we would just like to jump in, as you've already done the intro with the rest of the attendees, is to really just learn deeper about, you two, what you guys have been up and running for the past year or so. Start from my screen from Yusufa. Maybe you can just give us a brief background about what you have been up to for the past year, separate and as well, past as well.
Thank you, Modu. Yeah, so I'm an entrepreneur first and foremost, which means I'm either always building something or breaking something. That's the other side of the coin that we don't talk about so much, which is, things don't always go to plan, things fail, things take time, but I'm always in that process. And obviously I'm born and raised in Gambia. Well, not obviously, but I am. I lived in America for some years, lived in London for some years, and I moved back in 2010. And, some of you may remember, some of you may not remember, but December 2010, there was supposed to be a Mavado reggae, a show. And me and one of my good friends, Mawar Tal, we were the guys behind this catastrophe, and I won't point fingers, but it was Mamar's fault, Anyway, we were supposed to have the show, and we had sponsors, Coca-Cola, Gambia, Gambega, all these sponsors, Africell. And in the end, we couldn't raise the finances to bring Movado. And obviously, as an artist, you don't travel from Jamaica unless you're paid. So I experienced my first failure immediately straight out the gate, because within 3-4 months of trying to set this up, it failed. And, we were the Movado guys, and I had the Minister of Tourism calling me like, when is he coming? So disaster. But anyway, without going on and on, I've tried a lot of things. I've owned a few taxis in Gambia while I lived there from 2010 to 2013. I've been involved in commodities export, groundnut cake, groundnuts, timber, things of that nature. And then in 2013, I moved to Denmark, Copenhagen. My wife is Danish. We met in London some years ago. And I've been here now for 8 years. It took me about 2 years, 2-3 years to really get on my feet and really get a layout of the land. And eventually in 2015, I founded a startup, a technology startup. So it was my first attempt at tech. And that was in the genetics industry. We don't need to go into details, but it was about DNA testing. We raised some venture capital. We raised about €1 million total, grew it for 3 years. And in 2017, we sold the intellectual property. So, the reality is we didn't exit, but, we didn't make, €100 million or anything like that. Frankly, it was not a success. It was a media success, but a commercial failure, right? So we were on the covers of all of the Danish and Scandinavian media. If you Google us, you could see a lot of videos. But the reality is the company didn't make any money, right? Which is, it's fine in an early founder phase, but we were dependent on investment capital. And my job as a CEO, I had a few jobs, not a lot. One of them is raise money, make sure there's money in the bank. And I failed because I raised some, but I didn't raise enough to succeed. So the lesson that I took away from that was startups are fun. Building companies is a lot of fun. Technology is all sexy, but don't lose your eye on the bottom line. And so I went the opposite direction. And now, I do a lot of things, but mainly from the investor seat. But my main set of companies are in steel fabrication in the UK, and it couldn't be less sexy, but they're very profitable. We have 3 businesses in the UK that we bought. The youngest one is 18 years old, the youngest. The oldest one was founded in 1858. It's 160 years old. So here we're buying businesses that have been trading for hundreds of years, right? 160 years, but they make money. So I've tried a lot of things. I failed at a lot of things. I've learned at a lot of things, and I want to give back as the best I can. Currently, not a lot of capital in my pocket, so I'm sharing advice and what little capital I can get access to. But that's why we're here.
So over to you, Ndonga. Ndonga, can you hear us?
So I mentioned briefly in my intro that I'm a lot newer to the startup space. I worked in a large company for all of my career, pretty much since I graduated from college. And in that time, the past 2 years, I spent a lot of time thinking about what was important to me. And that is kind of what brought me thinking about Africa and development. And I know that when most people think about development, they think about aid and grants and things like that. But for me, I really thought about the private sector, and I really thought about businesses and having Africans create jobs for Africans. And that's what got me interested in the VC entrepreneurship space. And right now I'm leaning more towards investor because I don't have a company idea, right? So if I'm not going to create a company that's, giving out a service, then I'm going to create a company that's, investing in other companies. And so the past year I've spent a lot of time researching different avenues in which I could do that, from large corporate structures like the IFC that does have a VC group to smaller, more startup-like groups like the Safari Fund. And so far as I go through this journey of, as I mentioned, pivoting in my career, this is where I find myself, and learning is very important, and so that's my focus right now.
And use for that brilliant intro. So more of the reason why we thought of setting up this event was to give an access to more that actually that we were going to have them, but to so investment. I think a lot of small businesses understand the nitty-gritties that actually involve in investment. So I think here, and I would like to have an idea from all of you, is what do we mean by the term investment, and when do an entrepreneur or a small businesses start looking for investment? I think this is kind of really key for everyone out there that's listening, and as a blueprint for most of the small businesses, 45% of them in the Gambia, to really understand the investment vehicle before really thinking about going for investment. So I'm just giving it back to you guys.
No, makes sense. When you found your company, quite often you or your co-founders, your partners, you own 100% of the shares. So it's your company by definition. You own and control the entire thing. And a funny thing happens when you raise an investment. Quite often it's an equity investment. Obviously you can raise debt, in which case maybe it's a convertible note, not quite an investment, we can talk about that. But then all of a sudden you have new people that are shareholders in your business. And the funny thing is, it's very easy to do, but very difficult to undo. So in many ways, it's like a marriage. You can't just wake up 6 months after raising capital from an investor and say, come to think of it, we much like things better before you came, right? Because now they've bought a piece. It's theirs as much as it is yours. So I think first and foremost, when we talk about raising investment, we're talking about marriage, right? So we're talking about marrying and taking on a shareholder, an equity partner into your business. And obviously quite often that they typically pay their way in. So they invest through cash and then they get some shares. Although sometimes if an advisor is worth it, a founder may decide to give shares in exchange for advice or a board seat, things like that. I've done that before. So that was your first question. What is investment? My answer is it's really a marriage. And I'm sorry, I should have written it down. You had a second question in there. You had what was the second?
Really, talking about actually go for investment. By even understanding investment, I think, we've done the pilot, and I think we've seen a lot of small businesses really not at a stage where they should really go for investment. But from your experiences, you've dealt with companies that are 100 years old, and it took them a while before they probably get to the involvement of going
to that stage.
So it's really when is it ready? When do I have to be
ready? A good point. It's a good point. It's kind of like the question. I love the question, and it's a bit like the other question that says, "What is a startup?" Is a startup a small team in a garage trying to build a tech company? Is a startup anyone's business on day one? So if my uncle, launches a barbershop, is that a startup? Like, what does it mean? And there's no answer other than to say, quite often people say, a startup is a company that has committed to growth. So it's the commitment to growth that sort of makes the definition. So if someone starts a barbershop, and really the commitment is, and I put it in quotations, but just to open one barbershop and service people in that geographical region and never necessarily grow beyond that region, then that's just a new business as far as, I'm not doing semantics, but generally speaking. But, someone else could start a barbershop app that connects barbershops. And the difference is that they're committed to going from one location to 1,000 to 100,000 over the next 10 years. So even though on day one, they both look the same, 3 people in a garage, the commitment is what differentiates them. So the reason I give you this segue is I don't think most companies should raise investment capital. I think investment capital should be viewed as a fuel to fuel something. Quite often it's fuel to fuel growth. So you should not take, it to fuel debt, for example. So rob Peter to pay Paul. Business is bad and you can't pay your bills. So, you go raise a little bit of money so that you can pay even less of your bills. But, so my question to founders would be to say, though there's no answer, what is your commitment? What are you trying to build? There's no shame in building a small business that is regional, that will be run efficiently, that will make profits, and that will take care of you and your family and your loved ones and will better your situation. There's no shame in that. In fact, there's a lot of pride in that. And I just don't think that kind of business should try to raise investment. So I think companies that decide, look, we really want to go for it, whatever it means, can now define what it is, set a roadmap, a journey, and as part of getting there, a bit like you have a vehicle, you put fuel in the vehicle, and the fuel is the investment capital. I think that's the healthy way to think about it.
Wow, super. So I'm just going to go go to Ndonga. Ndonga, you've actually worked in Ernst & Young and doing a lot of auditing as well for probably larger companies. Key things, key takeaways from the pilot that we've done, we've seen that most of the small businesses don't also know about their numbers. So, and I think that is actually even causing a bit of like a mishap for most of them, because it's like, even if you're looking for different sources of funding, you're not able to show traction. You don't even know how to do it. So can you just take us through, from your experiences dealing with most of these large corporations, what your experiences have been really doing auditing, and really best practices for small businesses to do, to be able to present, not only going for investment, but present to potential helpers or family members that really want to support their business on really value for money. Like, how do you do this?
So, as I mentioned, so most of my experience is with really large companies like Microsoft, Google size multinationals. So I would never expect a startup to have financials as clear and, as structured as those companies do. They have entire teams, hundreds of thousands, if not millions of dollars spent on people who do it. And then they pay us to make sure they did it right? I think in that context, it is a little bit difficult to compare, but I would say in terms of founders, startup founders, know your numbers. So at least have some tables, at least know what was your revenue, what assets do you have, how much is your debt? And to a certain extent, we would expect a founder to have some of that information at the top of their head. If you can't tell us what your revenue has been year to date, what your revenue has, your lifetime revenue, let's say if it's a company that's like less than 5 years old, you should know your lifetime revenue, things like that, and then how much debt you have. And when we think about startups and coming forward to investors, I think one issue that we've had is a lack of maybe understanding of their valuation. And I think this comes hand in hand with numbers. And so I would definitely encourage that when you're thinking about valuation and you're coming to an investor, to remove emotion from it. So don't think about what this company means to you, because when you add things like blood, sweat, and tears, it's the most valuable thing in the world, right? So if you step back and you say, okay, what are the actual numbers on paper that I can use to support this valuation, then people can take you a little bit more seriously, because as an investor, you lose a little bit of credibility when, let's say, you made $10,000 of revenue and you're telling us you have a $20 million company. So it's really important to put pen to paper and write numbers down, and then to know those numbers and be prepared to talk about it when you're talking about investment.
Super. So, Yus, I'm just going to come back to you on, what you've actually spoke about in the beginning, but I mean, just link it to the idea of, how do I get investment? But then again, break it down to, what kind of financial support should I really look for, or should I go for at this stage? So I'll give you an example of a small business coming from the Gambia. You might want to do investment or look for investment from an investor, but might not categorically be the right thing to do at that time. So there are different sources of funding that small businesses can look at. I think I have one potential partner of an ice cream business that, I was actually planning to do. I think she's on the call. We were actually looking at getting funding for that business, but investment might not be the key word for us at that time. But then maybe if you can take us through what other sources of funding that before you actually even go for investment, what can you look out to get? Bootstrapping, family members. You've lived in Gambia, you've had taxis and everything. So I think, from a Gambia perspective or small businesses, like they need to know when to be ready by looking at all of these different sources of funding before going for investment. Then we can think big. So maybe you can take us through about all the other sources of funding that
I
is
think
linked to investment?
I think yeah. I'll answer the conventional, and then I'll zoom in on Gambia. So conventionally speaking, you can always try to raise grants, which is basically called free money. Um, in Europe, quite often it is free money. There's no equity attached. There's no debt attached. It's sort of European grants. Quite often they are sort of very specific. So it's sort of like health tech, med tech, or something that the European Union decides is worth financing. Perhaps they have things like this in Africa. Maybe ADB, Africa Development Bank, has programs where they've carved niches like agriculture, farming, technology, who knows? So obviously the first thing you could always look at is grants. The problem with grants though is it's a very noisy segment. Who doesn't want free money? I mean, I'll put my hand up, please. If you can send me some, it'll be quite appreciated, right? So everyone's going for this. And quite often it's difficult to stand out and be unique and tell your story. But grants. You mentioned the next stage. This is, by the way, conventional, and then we can zoom in on Gambia. But of course, what's called friends, family, fools. It's not a very nice term, but it just means, whoever or whomever you can get to give you a little bit of capital. It could be the neighbor who believes in you, or a former school teacher who believes in you. Maybe they know that you're a very intellectual individual. People close to your inner circle who, aside from just the merits of your business idea alone, can look to you as an individual and put a little bit of seed capital down. So that's typically the next stage. You then obviously have the word I just mentioned, seed capital. That's quite often, let's say angel investors, or it could also be professional investors, semi-pro investors. But that's people looking at your business and saying, does this business deserve capital or not? Can this business absorb capital efficiently or not, relative to other opportunities where capital can be deployed? Frankly, this is the lens that we take, the three of us, when we look at companies. We don't necessarily have an emotional attachment necessarily to these founders on day one. We're strangers. So the connection we have is the merits of their case. And obviously we may build a relationship going forward, but we're looking at it through that lens. Beyond that, you now get into sort of the very professional, what's called institutional investor realm. And this is typically called a series. So series A, B, C, etc. So series A would be the first institutional investment into a company, series B being the second. So in my last company, for example, we raised, you could call it a seed round or series A. It was from a professional institution, but it was not a lot of money in the European context. So that's the conventional wisdom. Okay. Now, scrap everything I just said, because it doesn't work in Gambia. Because, as we know, Gambia doesn't have, institutional investors looking at a case and saying, if we put $1 million Series A, can they raise an $8 million Series B? That infrastructure just doesn't exist. So what we have, my understanding is, we have the friends, family, fools, and we have some hybrid of angel investor / seed investor, wealthy businesswomen and wealthy businessmen looking back at the community and saying, I'll do my part, I'll give a little bit of capital in. So that's sort of your opportunity. And if we don't let our imaginations run wild and say, I'm an outlier, I'm going to build a great tech business that'll then raise money from Senegal or from Mali or from Mauritania. Very feasible, probably not for most Gambian startup stuff. So I'll be more broad with them. I think what Gambian companies should look to is to say, what is the path to break even for my business? And I don't mean, the path to millions and millions of dollars in profits. I just mean the path to break even, where you become the master of your own future. An interesting thing happens when you've broken even. You don't need to take on debt to pay your bills. You don't need an investor to pay your bills. You can keep trucking along indefinitely. And obviously, you can then work on optimization and growth and incrementally grow. So it's a critical point, that break-even point. And personally, I didn't achieve it with my last startup in 2017. We kept requiring investor capital. And when I failed to raise, we were trying to raise 5 million euros. It's such a thin line between success and failure. 8 weeks before, We're so close to 5 million euros. 8 weeks later, we're selling the intellectual property basically for free. And that's it. That's entrepreneurship. It's so close, it's so thin. So why gamble with your life's work? So to answer your question, I think founders should raise money to get them to the break-even point, or when they're broken even and they're comfortable, that what's called a unit economics can accelerate the growth of their business. So I think these are the 2 points. It's a very long answer, but I think it was important for me to drill a bit deep.
So Ndonga, just to follow up on what you
one thing.
Yeah, go on. Yeah.
So I want to add one thing. Even when you're at a point where you're looking for capital, I think it's important to keep in mind where you're taking your capital from. You know, one thing that I've learned from speaking not only to startups in Gambia, but a lot of startups in the US is, you know, that one thing that a lot of founders keep in mind is dumb money and smart money, right? And so what they define as smart money is basically who is this money coming from? And for example, when, you know, Modu, Yusufa, and I speak to a new founder, we start with our background and our expertise. Why? Because it's to show that we come with more value than just dollars or dalasi, I guess, right? It's talking about expertise and ways that we can connect you perhaps maybe with different investors or maybe with different entrepreneurs in the same space that you might be able to learn from. And so wherever we're operating from, even if someone is giving you a large sum of money, it is important to ask yourself, what else, you know, does this person come with, and what is this person's reputation? If you know other entrepreneurs who are maybe in their portfolio, is what they call it, it would be good to actually reach out to the other founders and ask them what working with that investor has been like.
Yeah. So just to follow up on that, maybe you wanted to add something there, or okay, okay. So,
agree.
So basically, I mean, very hardly do we see a lot of startups in Gambia or small businesses. We reject certain money from investors. I think what we have is like, we have most of them struggling financially to keep their business up, but then we have most of them also losing value. And I think this is very important. And I think most investors that are probably interested to come back home and invest are not only investing because of the money, but are investing because they want to give back or support you to actually move to the next level. It's very hard to see. When we did the finalization on key areas on where we wanted to invest in, I've had a feedback from one of the small business owner that actually told me that she's not willing to go for investment. And I think that was really candid, because probably she went back and, did her studies and realized that this is not the right time for her to actually look for investment. So what are the values that an entrepreneur or a small startup need to have before they go for investment? In terms of personality, in terms of character, in terms of what are the values used? You've come across different companies, really disciplined. I'm sure there are areas where they've rejected certain deals. What kind of values?
I think it's helpful for anyone, including entrepreneurs, to accept that we can't do everything by ourselves, right? Even you look at the most valuable company in the world, Apple. Apple was more than just Steve Jobs. Obviously, he was the person at the very front, but hundreds of thousands of employees. That's what it takes to make Apple a success, right? And different people playing different roles in the business. And similarly, I think entrepreneurs, hopefully they get to a stage where their business is maturing and their strategic think is a bit maturing, where they accept, maybe I could use a hand, right? Maybe I could use a bit of help. And that can come in many forms. That can come in the form of just advisors who happen to have some of the skills and experience you need, who have no equity in your business. They're simply advising you for free. That could come in the form of having key employees that you hire who can do the work better than you can do the work. But that could also come in the form of taking on capital from investors who now not only feed your business or fuel your business with money, but now have skin in the game, it's now partially their business as well. They have a vested interest in its success. And if they have some sort of expertise or skill or background that's relevant to you, then it's when Ndonga was mentioning about smart money. So I think the thing I love about business is there's no rules. You can break all the rules. I mean, you can be a founder of your company, own 100%, never take any advice, say everyone's wrong, and go build a $50-100 million business. And congrats. And by the way, I know some people like that. I know some. I won't say the names, but some businessmen in Gambia. I have one in particular, late 60s. That's exactly how we built this business. Just the most grumpy person ever. But it works and it's successful. And why should he share? So I get it. I guess what I would just say is I would encourage them to open their thinking to what resources does this enterprise need, including capital, including employees, including potential advisors and investors.
Super. Ndonga, do you want to add? Or...
Yeah, well, the one thing I'll add is definitely doing more research and attending events like this, but also doing more research on investment and equity, and shifting from the mindset of having a sponsor or having somebody give you money, and really understanding this relationship, right? And it should be a mutually beneficial relationship between the investor and the entrepreneur when you are, ready or at a place where you're thinking about looking for investments, because you definitely don't want to be disappointed at the thought of giving up equity, but that really is the conversation you're having when you are talking to VCs or even angel investors.
Interesting. So, I've actually had an event in partnership with the GCCI where, we call it, Are You Doing Enough? And funnily, most of the ESOs in the Gambia actually talked about the reality of small businesses not really having viable tools like business plan and pitch deck. So they are a bit of a proclamation that I'm sure you might want to touch base on this, on that business plans are actually getting outdated at this moment. So because most investors actually probably don't have time or probably prefer pitch decks. So maybe if you can just give us an idea on, when do we really need pitch decks or business plans? A lot of small businesses, business plan has a lot of information. It has capital, it has mission statement, vision, and a couple of stuff. It's like pitch decks might be just a couple of pages, little pins. So,
Exactly.
So which one should we go for?
No, I love the question. These are tools, right? And I love the question. So if you look at the mirror side of that question, it's what are you trying to achieve? If you're trying to convince, a family friend to put the first, $10,000 in your business, maybe you don't even need a full pitch deck. Maybe you just need, a couple of pages, just sort of referencing and highlighting some things you've already said over dinner, sort of illustrating your ideas. If what you're trying to do is very quickly, efficiently communicate, to strangers, your concept, the value proposition, and why they should invest in you, then you probably need a pitch deck, which probably should be colorful, because we're humans at the end of the day. And if I'm at the supermarket and some boxes are pink and the other boxes are gray, my eyes go to the pink boxes first. So it probably has to be enticing and colorful, but obviously have substance. Pitch deck. Okay. Now, if you're trying to map out your business's future, if you're trying to aim and say, look, I'm aiming for the moon, the business plan is sort of your GPS coordinates, right? You're saying the moon is so far away from Earth, there's gravity pulling on me, I'm using this rocket to propel myself. And if you don't document this, then my friend, you're dreaming, right? Because you don't have a clue. So I think a business plan is more a tool to sort of a self-reflection. And by self, I don't just mean oneself, but oneself and one's team and people within your ecosystem on your team who would like to, reflect on you. And then guess what? The value is in the preparation. The value is not in the reading, which is why it's probably not valuable to investors. They have no value reading your business plan. They don't want to read your business plan. No one. You don't want to read it. I've made a business plan. I haven't read it, right? So where's the value? It's in the creation. It's in the coordinating, the GPS, the trajectory. But I don't think that that's not valuable. It is valuable. But obviously, it depends on what you're trying to achieve. But, you don't need a business plan. That's for sure. I mean, there's so many examples. Just to give a famous one, Richard Branson started more than 300 businesses. I guarantee Richard Branson has never written a business plan himself. Maybe someone on his team has had to for some bank legal process, but Richard Branson is dyslexic, right? He couldn't, T and F, he would confuse these simple letters in school. So he did not write business plans, yet he's a billionaire. So you don't need a business plan. But I guess what I would suggest is think about what you're trying to achieve. For this new journey I'm on, I don't have a business plan yet. But we have something, we've done the similar work that you would do when making a business plan. We've done the work, we just haven't put it in a readable business plan. It's in a maybe 40-page presentation. But the work, the value is in the work. What are you trying to build and why is that interesting? And are you going to miss the moon or will you even get off the ground? Failure to launch, right? So a lot of analogies, but I think you get the point.
All right, super. So I'm just going to go to Ndonga risk in a business. So I think a lot of risk when it comes to really a successful pivot to investment. Not only get investment, but some investments are really risky. As they always say, the most expensive. I think it's more about, when you get the wrong investment as well, you're at the dead end. So from your experience dealing with, large corporation, I'm sure there's a constant audits just to make sure that checks and balances are actually normal. What are the strategies that can small businesses adopt in terms of minimizing for investment?
Sorry, Modu, I don't think I understand the question properly.
So my question is more about risk. What can you do as a small business or an entrepreneur to minimize risk of taking bad investment? Because it's not all investment that are actually good for businesses. So what kind of risk can you really do? Risk management strategies to actually minimize you from, taking really bad investments as well.
Yeah, okay, so definitely one of the ones I mentioned earlier of making sure that you do your research on the investor, because the investor is going to do a lot of research on you. They call it due diligence. And traditionally, due diligence can sometimes even take, 6 months. I spoke to a VC who said sometimes due diligence takes 15 months, right? They're doing that much research on you. So it's also important for you to do research on the company and the partners and who you're working with directly. Something else I think to manage risk of investment internally is taking the temperature on your team, right? Because it's very important that if you're taking in an investment, you have a team that's as passionate as you are as a founder and that's willing to stick with it for the long haul. Because the last thing you want is to get investment. Let's say you get $1 million of Series A funding, and then your COO gets a better opportunity at McKinsey, and your tech guys get an offer at Google and they go. You're really in a difficult position because there's no such thing as a free lunch. It's going to be really risky to have that capital and be in a situation where you may not be able to pay it back or scale your company. So internally, I think it's very important that your structure is solid before you inject money in there.
Okay, super. So you've actually acquired, a couple of companies over the past few years, but there must be some value and ethics and drive, and most of these attributes that convince you and your partners to really acquire these companies. I mean, the topic of the discussion is what successful entrepreneurs do to get right investment. So there are a couple of strategies that businesses need to have to get there, to really acquire it when they're ready, on the line when they're ready. So maybe you can take us through on some of these strategies that you have seen, best practices that anyone out there, a small business or an entrepreneur needs to have. And I think this is the key word, because it's not about the money, it's not about the millions, the dollars. Small businesses, when you hear about this money, you're out. I mean, but
absolutely.
there are a lot of values that one needs to have before, that can convince an investor to really get there. So maybe you can just take us through a bit. I think we have like 10 minutes before the event wraps up, but yeah, that would be super.
Okay, so a company goes through different phases. Sometimes they melt into each other, and quite often founders are tapped on the shoulders and told, hey, you're now entering the other phase, so prepare in this way or think of things in that way. But there are phases. And I guess the final phase of an entrepreneur's journey with a particular business is the exit phase, when they are selling the business and by definition, handing over majority control to someone else. And the funny thing is, when an investor is looking at a business to invest in, quite often they are looking to back a founder that's passionate, that's driving the business forward very ferociously, and in many ways, a business that can't really live without the founder, right? I mean, it's like the founder, because they're backing people, and it's like, well, this person, this woman, this man, this little young boy, this young lady, they're gonna make it happen, even if they run into challenges. So you're backing the individual, and in many ways, in spite of whether or not the business itself is currently going through a tough time at that moment. The funny part is when you're buying a business, it's the opposite. The easiest way to not have your business be sold is to have a business that is completely dependent on you. Because when you sell the business, a buyer has to assume that you may lack the same motivation that you had before you sold the business. And now that they've handed you some money, presumably you're not showing up to work all the time. It's a risk at least, and working as hard, adding the same value. So the business, the asset, has to be independent of the founder quite often, or the shareholder structure. So when we're looking for companies, I'm looking for a few things. First of all, I'm looking for not small teams. Let me just add the caveat though. Even though I built a tech company, now we're investing in sort of non-necessarily tech companies. It's about the money. Do they make money? And if we buy a company that's run by 5 people, including a founder, and the founder leaves, and another person gets upset, or they don't like us as new owners and they leave, we've lost like 25, 30, 40% of the key workforce. Even though we may be able to replace them, it's a problem. So first thing is I buy companies that have some critical mass, some employee base, some culture within. And just because things are easier with nice round numbers, I put a nice round number of 20. But it doesn't mean anything. It could be 12, it could be 50. So that's one thing. What are we getting? The other thing, and this is again from my side, we are not strategic buyers that are. But when Facebook buys a company, they're buying technology. When Google buys a company, they're buying technology, right? So Google may buy something and call it G Suite, right? And make it their email platform because they didn't have that product. That's not what we do. We buy standalone businesses that are profitable in their own right. So we do due diligence in that sort of in that sector. So I pay a multiple of earnings. In Silicon Valley, they say that they value businesses based on how many engineers one has, right? So $1 million per good engineer. We don't care about all of that. We look at does the business generate earnings? We're effectively, it's not a nice thing to say, but we're buying money, right? So we pay X to get Y return on invested capital over Z amount of time. So that's what we do. That's a long ramble, but I guess what I would say for any entrepreneur, any founder, they should just think and say, what am I building? Am I building a business for life? A bit like that late 60s individual I mentioned. Then you probably shouldn't raise any money because investors want an exit event, right? They want a return on their investment. So either you're going to be paying them dividends, meaning you think you're going to be profitable, or you're planning an exit. Or you say, I want to build a business, grow it, and keep improving it and keep increasing the value indefinitely, eventually list it on a stock exchange, and be like, some of these companies, Snapchat or Facebook or whomever, Twitter. That's another journey. Or the last journey is building with the feeling that, hey, if a good opportunity came to exit, I would sell. So if you're in the third bucket, then the things I've just said are relevant for you. If you're in the other buckets, then less so.
Super. So we're just gonna wrap up with Safari Fund. We've been working on it for the past few months. We have interviewed a couple of startups that are actually doing well. So it would be nice for all of you to share your insights about what you've learned so far and where do you see the trajectory going. We've seen incredible stories. We've had very emotional ones. We've had very promising ones, but it's not all of them that probably we're going to support. So tell us a bit about your experiences really and your interest on what you have seen about the Gambian startup, based on what they have pitched so far within the Safari Fund. Advices that you have for startup. I think it would be great to share with them as well. Maybe Ndonga can.
Would you like to start, Ndonga?
For me, I think something that I was very pleasantly surprised by was the amount of tech companies that were in Gambia. So a lot of companies really trying to do, well, not a lot, but if and trying to digitize processes, whether it's sending things from the market to digitizing health. And I just was not expecting that. So that has been interesting to hear. And also hearing about the very real struggles of trying to digitize processes in the Gambia where, our internet is not that great. And so seeing how companies can be limited by the infrastructure of a country, even if the founders are doing everything right. And how unfortunately, one of my favorite companies really ended up being uninvestable just because of the context of being in Gambia. When it came to scaling, because it was almost like Uber-like, which just would be really difficult here with not everybody on smartphones. And so that has been an interesting learning process, and it has definitely made me think more big picture about how the country would need to develop for certain startups and certain founders to be successful. And there are also a lot of small businesses that kind of, as Yusufa has alluded to, just we're meant to be small businesses. And I think this is the first time that I've really encountered that talking to startups where it's like, you're doing really great, you're very successful, but we think this is a business for you and your family, and it can really just do well for you, not really for investors. And so, and when I think for the future, I do think it's possible to have, a Gambian unicorn maybe. Will it be next year? No, I think it will be hand in hand with the development of the country. But I do see successful investments in Safari Fund's future as we work as a startup ourselves, right, with seeking outside investment, but also work with educating our founders on making yourself more attractive to investments, because the dream is also a few years down the line is to create a of structure and ecosystem where we can expect a Series A after the seed and pre-seed round, where we can expect a Series B. So that would be relationship building on our end with other VCs, maybe in Senegal, maybe in Nigeria, and onwards. So
super. So maybe Yus, if you can touch on that. We also have a question from Turiyalai from Pakistan. Okay, but maybe I don't know whether Yus you want to take on that or.
I'll just add a few words just to say I'm really impressed with the level of conviction that the Gambian founders have. They're not saying, "Oh, I think maybe I might be able to." They're saying, "Here's my business. Here's what we're trying to do." And if anything, it's us saying, "Are you sure that's possible? I mean, have you looked at the data?" So I love the conviction, and I agree entirely with what Ndonga has said. But let's please take to realize a question.
Yeah. So he's saying, what is the optimal organizational structure you guys look for during the due diligence process while investing in a startup? I think it's more about the process that it's taking before investment. Yeah.
So I like to think of due diligence as being in three buckets. I think in simple Simon terms. So for me, I like to simplify things. So three buckets. There's financial due diligence, there's commercial due diligence, and there's legal due diligence. And financial due diligence is basically some of the things that Ndonga has touched on, given her background. If an entrepreneur says to an investor, we did $500,000 in revenue last year, $250,000 the year before, and we think we'll do $1 million next year. That's great. Great that you said that. Show us, show us the accounts, show us the bank statements, show us the revenue going through the business. So financial due diligence is just the process of making sure that the finances are in order and as represented. The second is commercial due diligence. Commercial due diligence just means if a founder says, as we all do, we all have tried this at some point. You go to a meeting with a potential client, you really want them to sign up. They've let you in, you've had the coffee, you haven't even met the decision maker, maybe you met the person's assistant, but the assistant was smiling the whole meeting. So in an investor pitch, you say, they're very interested. We're so close to closing that deal. Great, show me. So commercial due diligence is just to say, have they sent you an LOI? Can you show me the email correspondence? Show me the commercial gravitas that you have been promoting. And lastly, legal due diligence. Again, this is kind of simple. It's just to say, if you set up a limited liability company, what are the articles? What are the registration documents? Maybe you set it up a few years ago and to get the paperwork done at the time, you had your aunt take 1% in the business. But now your aunt owns 1%. You forgot about her. 5 years later, you're raising money. You think it's your business. Who is this lady with 1%? So legal due diligence is the shuffling through documentation to make sure that the docs are in order. So commercial, financial, legal due diligence, and it's basically, they say trust but verify. Right? So as a matter of fact, you can trust me, but verify. Everything I've just said, I've come, we've talked for 1 hour. I said a lot of things. Great. Go verify. So that's due diligence in a nutshell.
Yeah. All right, super. So that wraps it up. We're at 6 p.m. right now. So thank you so much. I think we've just lost Ndonga. But thank you so much. And thank you to everyone that has actually joined. Maybe if you want to share any key takeaways or last words from this edition, you can go ahead before we wrap up here.
Yeah, I would just say I think these things are a lot of fun. I'm glad that we had some people show up. Thank you so much for your time, guys and girls. I noticed that some came and left as well. So thank you to everyone that came. I'm on LinkedIn, so you can see my name right here or on the event description. I'm happy to stay in touch. Please feel free to connect with me on LinkedIn. Quite often, we have chats with entrepreneurs. Mariama Danso is here. She's a part of our now. Good to have you here, Mariama. If you have a business idea or plan or a company that you're running, would like us to take a look, feel free to send it in. But I just want to say I really appreciate you guys giving me this platform. And Modu, thank you so much for setting it up.
Thank you so much. And until we see you again next time, thank you, everyone. Bye.
Bye, everyone. Bye.